So today I'm going to teach you a little bit about a method that a lot of very successful real estate investors use. That's called the BRRRR method. So BRRRR is an acronym. It's BRRRR. All right. Now, the BRRRR method combines elements of both flips and buy and hold, and it allows investors to build portfolios much more quickly and efficiently without having to constantly raise more capital. All right, so here's how it works. First and foremost, let's talk about flips and let's talk about buy and hold. So a flip is when you buy a property, you renovate it, you sell it for a profit. It's one way to make money in real estate. However, it's extremely risky and the margins on flips are very low. I tend to not recommend flips for new investors unless they're contractors or people who are able to, have access to cheap trades, cheap labor. The other way is to just buy and hold, right? You buy a property, you rent it out, and over time, equity builds, and eventually you get to a point where you're cash flow positive. The problem with that method is it tends to be slow, right? So it takes a long time to save up enough money to buy the first property, and you get into that property. A lot of the times, you're lucky just to break even on it on a month-to-month basis, and then it's kind of a slow build of equity until you get to a point where maybe you've saved up enough money again to buy a second property, and then a third, and a fourth. Right, so the BRRRR method, again, combines elements of both flips and buy and hold. All right, so what BRRRR stands for is buy, renovate, rent, refinance, and repeat. And I actually think you could even add a fifth R in there if you wanted to, and you could call it the buy, renovate to repurpose, and rent, refinance, and repeat. And here's how it works at a high level. So once you've got the money saved up to buy a property, what we'll do is we'll identify a property that needs work, right? Ideally, it's a vacant property. Ideally, it's a property that's already got 2 or 3 units to it, duplex, triplex, or a property where you could add units. But the key thing is it has to be a little bit more of a fixer-upper. It's got to be dated, it's got to be ugly. It's got to be the type of property that wouldn't generate a lot of rent now, right? So that's the B, buy. Then we go in and we renovate, right? So we make these, sort of ugly units, dated units with maybe problems. We fix them up, we clean them up, we make them look a lot more beautiful. And then by renovating them, what we do is we increase their fair market rent, right? So that's the second R. We then rent them out at fair market value. And in doing that, in renovating the property and then increasing the overall rent that property generates, we increase the value of that property. We increase the amount of equity we have in the property. That's where the third R comes in. So we go to the bank and then we ask to refinance the property. They look at it. When banks evaluate rental properties, the amount of rent that the property generates plays a pretty huge factor in what value they will attribute to the property, right? So because we've renovated, because we've increased the rents, the bank will typically evaluate the property at a much higher rate, and that allows us to pull a lot of the new equity that we've created right back out and then repeat the process. Take that equity and go buy a second property. So again, you buy a property, you renovate it, you rent the units back out at fair market value. Ideally, you renovate to repurpose, which means essentially adding units, right? Rent them out at fair market value, create a bunch of new equity, go to the bank, pull that equity out, start the process over. So rather than having to constantly save up more money through your day job, you're able to essentially use the same funds because you increase the value, you pull those funds back out, you do another project, you do another project, you do another project. Now, a perfect BRRRR is when you are able to pull out the same amount of money that you've invested in the project when you refinance. Obviously, it doesn't always work that way. Nothing's ever perfect. However, with the right guidance, with the right selection, the right negotiation, and the right renos, you can definitely have a ton of success in this method, and you can build a portfolio, a real estate portfolio that will actually pay you a lot more quickly than you would using the sort of long-term buy and hold, buying things that have already been renovated by others, and with a lot less risk than you would doing flips. So I'm a big believer in the BRRRR method. It's something that I do with a lot of my investors, especially new investors who don't have access to millions of dollars. I think it's a great way to provide quality housing for people that need it and to make some money for the people that are providing it. So if you'd like to know more, I do work with a fair bit of investors. I'm fairly well versed in that space, and I'd be happy to chat. You can feel free to use the Calendly link to book a discovery call with me. It's right there in the bio. You can find it on my website as well. That's it for this month's educational video. I'm Serge Papineau, and I'll see you next time.